That year, the United States sold 5 million tons of corn to China. We were pretty much the only supplier of corn to the world. China was short. They came in and bought 5 million tons, and it sent corn up to $5 for the first time. The subsequent year, they bought 2 million tons. The year after that, they bought 0. So it was a blip. It was Chinese demand that happened quickly, and it was gone. Since then, since 96, 97, they've been virtually a non-existent buyer of all types of feed grains. Doesn't matter if it's corn, wheat, barley, DDGs, which weren't around in the early 90s of any consequence, up until 2009. Starting in 2009, we saw China become a much more aggressive buyer of all different types of feed grains. Today, they buy over 25 million tons of feed grains. Most of it is in the form of milo and DDGs. There are also portions of it that are barley and feed wheat, and there's also corn, which is the bottom part of the chart, which is in red. All of that today is coming from the Ukraine. Again, the U.S. is not participating in the corn portion of this. We're participating heavily in the DDG side of it, and then also the milo side of it. And we're selling more DDGs and milo today to China than we ever did corn in 95, 96. The story isn't so much a DDG or a milo story. The story is China's buying 25 million tons a year of feed grains on top of them having 9 out of 10 years record corn production. Their corn production isn't a record because they had record yields every year. Their record production in China is because they kept expanding acres, and their government program of supporting Chinese producers with a market price that oftentimes was $3, $4 a bushel above the world market price. That incented them to continue to expand acres. To expand acres in areas that probably shouldn't have been growing them, but to expand acres anyway. So on top of them having a hyper expansion in acres for corn, they've gone from virtually 0 to 25 million tons of feed grain imports in 7 years. That's not a bearish story. It's just getting hidden in our oversupply situation that we have in all feed grains today. I don't view some of this, when you look at why is China buying this when they have all these stocks that, they have about half to almost 60% of the corn that they have at the end of the year compared to what they need. So you take their full year's demand, when they get to the end of the year, they still have 50 or 60% of that crop left over. That's very different in the United States. When we get to the end of our crop year, which is September 1st, we typically have 5 to 6 weeks worth of corn left. China has about 6 to 7 months worth of corn left. That's very intentional on the Chinese part. It's nothing for China to have 90, 100, 110, 120 million tons of corn. It's like 4 billion bushels of corn left at the end of the year. We think 2 billion feels really heavy. We have 400 million people, they have 1.2 billion people. Let's just keep everything in perspective when it comes to China's size of population. So despite the fact that they've grown their production that much, they're also increasing feed grain imports. I don't want to make any bold predictions or anything like that, but my opinion and the opinion of our group is if we were able to see what the next 5 years looks like, it's going to continue to grow. We're going to get 30, 35 million tons. We're likely going to see some corn coming from the United States. We're likely going to see a continued growth in DDGs. One of the big reasons they took milo this year in a big way was because they got around their internal GMO issue they had with corn over a couple of unapproved varieties or whatever, unapproved events. And the milo was a workaround. Milo got that story off of the front page, but it's still a feed grain. It's being used for the exact same purpose that corn's being used for. It's just a hog feed. So the growth story for feed grain demand in China we anticipate to continue. Again, that's a bullish thing. It's just going to take a little time to chew through some of the stocks that we have today. When we look at an S&D, I know you guys look at these every single month. We look at them every month as well. We dissect every number. That's our job. But at the end of the day, there's only one number that matters on a supply-demand report of any commodity, for that matter, and it's this stocks-to-use ratio. If you were to take the ending stocks and divide that into total demand, that percentage can be tracked very, very well, and it tracks in a very linear pattern to price direction. If you see stocks as a percent of use, 10% or below, that means we have about a little under 4 weeks worth of corn left at the end of the year. If we're at 10% or below, we're typically in an upward trending corn market for price. If we get above 15%, we're typically in a downward trending corn market price-wise, and we're right in the middle there. There's been some comparisons, and they've been inaccurate, to some of the prices and returns and profitability to farming of the early 80s. This 13.3% is nowhere near the early 80s. This number in the early 80s was over 30, not even close. We are not in the early 80s. So you want to look at what our corn production was in the early 80s, it was 9 billion bushels, and today it's 13. But how much we use of that crop and the percent of it that we have left is substantially smaller. To put this into another term that I think all of you can really relate to, the average trend line yield for corn this coming year is going to be around 164. That's the long-term trend. If you were to take 25 or 30 years of data, plot out the trend, or plot out the yield of those 30 years and then put a line through it, the trend line yield is around 164. If we have a 159 crop yield, which is 5 bushels below trend, this number goes to 10%. If this number goes to 10%, we're very easily talking about 450 corn again, 475 corn again. It's not a stretch at all. And we're only talking about 5 bushels below trend, which has happened many, many times. So we're not in a situation where the long view is we're in this burdensome supply and there's no way out and we'll just continue to be choking on this mountain of corn. The world has plenty of corn today, no doubt about it. The rate at which we're chewing through that corn is faster than any other rate we've ever had. What we need is good old lady Mother Nature to give us some help somewhere, preferably somewhere in South America. We don't want her to give us help here. But wish ill on our southern neighbors. Which, if we think about it, I mean, I'm not a meteorologist, I'm not going to pretend to be one, but I read a lot of them. There's a lot of weather talk out there. How many people have read somebody or heard somebody talk about the El Nino to La Nina switch and when that's going to happen? And if it happens early, that might be bullish prices because that means we typically shift into a hot and dry summer. If it happens late, it's probably not bullish because that means the hot and dry won't happen until the fall, you know, that kind of thing. We've had volatile weather already this year. One of the El Nino traits is a wet spring, especially in the central and southern corn belts. I got a whole spring's worth of rain in 2 days in St. Louis. It was about 11 inches. We don't need any more rain, but the idea of having a wet spring is common amongst most meteorologists. Everyone feels like we're going to have a wet spring, but how quickly that turns into a hot and dry summer is going to be very critical. The market's going to trade a drought before we have a drought, guarantee it. So we don't need to be on July 20th and 105 degrees and it's our second week in a row with no rain for us to have the price increases. The price increases will have happened 2 weeks earlier than that because it's going to be traded on the weather models. So we don't need to have the drought, we need to have the drought scare. And there's a chart here on some fund positions that are also going to be a catalyst to that rally if we see it. So anyway, that's the supply-demand chart. Once again, I'm walking over here because of Tim. I've already mentioned this, so I won't spend much time on this slide. This is corn production. You go back to 1995 to 2015. This is total corn production. You can see that the last 3 years are the biggest 3 years we've ever had. Last year was the record at 14.2. This is not to say, I mean, this is the same in the world. The world has had 3 crops in a row that have been records, or not consecutively, but the last 3 years have all been records for that time. When you look at state-by-state data, last year we had 9 state records for yield. We had a state record for yield in Iowa, we had a state record for yield in Minnesota, we had a state record for yield in Nebraska. 3 out of the top 4 states had record yields last year on corn. Illinois, being the number 2 state, was the only one that did not, and that's because we blew all these records out of the water last year with 200. But Iowa at 189, we saw Minnesota at 187, Nebraska 187, all those are records. This again just points to the supply issue that we have and how long will Mother Nature continue to bless us with good weather around the world. This chart here is a state chart year-over-year production. This is still corn. So when we look at Illinois, for example, there's a minus 418, kind of a hollow circle. That means that last year's corn production was 418 million bushels larger than this year's. This year's was a drop versus last year. Shouldn't surprise anyone given some of the state yields that we saw last year. You look out west, Iowa grew 127 million more bushels of corn. Minnesota grew 271 million more bushels of corn. Other than being just kind of interesting to look at state data year over year, this is really a basis chart. When we look at this chart and we look at this type of data all the time, we're studying basis. We're not really studying flat price. We have seen in the last 3 years, and I'm just going to use an ethanol plant example, an ethanol plant in Ohio and an ethanol plant in Nebraska. For the last 3 years prior to this year, the average difference between those two basis levels on corn has been 5 cents. From all the way from Ohio to Nebraska, there hasn't been much more than 5 cents. The average is 5 cents difference. Ohio being slightly higher than Nebraska. Today, there's an ethanol plant in Indiana. Most of them are paying around 45 over, and in Nebraska, most of them are paying 25 under. So we're 70 cents apart today. The reason for that is explained in this chart. We did not have a consistent crop from east to west. Even though we had a large crop because of some of the phenomenal yields, in particular in Minnesota, we're disconnected from where the areas of surplus are and the areas of deficit are. So it's a basis chart. The other thing that a point I want to make on this particular chart is there's a lot of things happening because of that basis difference with the railroads. We're seeing a lot of railroads move western corn to the east, from areas of surplus to areas of deficit. That rail move has to be paid for. That's the justification for the basis spread. The difference in spread compensates for the basis cost, or the rail costs. If you would have asked either the BN or the UP, which are your two main western rail carriers, if you were to ask them, I want to move a Minnesota train to Indiana, they can do it. I mean, the railroad tracks go through Chicago. You can do that. You'll switch to one of the eastern lines, either the CSX or the NS. But if you were to ask the western carriers that in the last 5 or 6 years, they would have said, go take a flying leap. Not going to happen. Don't even talk to me. Don't care. The reason is they were short of power, they were short of people, and they were short of cars. The reason they were short all three of those things was because of the big oil boom in North Dakota, South Dakota, and parts of the Bakken and the Canadian oil sands. At $27 crude oil, that business is not booming. That business is dying. And so the availability and the willingness of the railroads to do these moves now is much higher than it has been in the past. We are seeing, on average, in St. Louis, St. Louis is one of the few places that large commercial companies are investing in barge loaders, with the exception of Canton, Missouri, in the last 5 years. But when you look at how many people are building in St. Louis, the reason is all the major railroads go to St. Louis. Today, and this is driven a lot by the bean program, but today we're unloading about 10 shuttle trains of corn and beans and wheat, the combination of those three every single day. A shuttle train is 110 cars, so there's 800 to 850 cars unloading every day in St. Louis, and that's because the railroads have been very willing to put rates in place to do that. Most of it's all coming from the west. There's also these North Dakota corn is being ground in an Indiana ethanol plant today. South Dakota corn is going to an Indiana ethanol plant today. So the willingness of the railroads and the discrepancy in the crop sizes and where they happen. We grew 562 million bushels less corn this year than last year nationally. The problem is we also brought in from a beginning stocks about 550 some million more bushels. So our ending stocks number this year is very, very similar to last year, not because of crop size. Our crop size was actually quite a bit smaller, but our carryover from the previous year, which was at that time a record, and it's still the record for corn production, it's our carry-in stocks that we pulled in. Ethanol margins, I bring this up for a couple of reasons. One, they're very different now than they were maybe the last time I was here, certainly when I was here 2 years ago. Ethanol margins are actually negative for the most part in the United States, especially in the East where they're paying higher for corn basis. If you go back 2 years ago, a 100 million gallon ethanol plant was probably making anywhere from, on an annualized basis, most of them probably brought in 55 to 60 million in profits in 2013-14. If you were to take today's number and annualize it, it would be zero. They are making zero money today, and many plants are losing 2 or 3 cents a gallon. There's maybe a few very efficient plants making a few cents a gallon. I don't bring that up because I want to give you the impression that we're going to slow down the ethanol industry. I actually don't think that we will at all. We still need our, I don't know if you've noticed, but the trend in gasoline consumption, I'm going to go off script here for about a minute. Gasoline consumption peaked in 2006, started to drop off heavily in 2007, 8, 9, 10, which was $100 crude oil. Something about putting $3.50 gas in a car cost somebody to buy a Prius over an F-250. Maybe not in this room. And how many Prius owners? Anybody willing to say? Not a one. They all live in California. Gasoline consumption has come down all the way through 2013. It come down. 2014, 2015, we are seeing a rapid increase. It's actually surprising the EIA, the Energy Information Group. It's surprising how quickly we're seeing gasoline consumption rise again. That's a great thing for ethanol. The more gasoline we consume, 10% of every one of those gallons is ethanol. We need today, we're operating the industry at about 96, 97%. There's only a couple of plants that are idle today, and they're idle for different reasons. 95, 96% of that, of what is being produced, we need 95% of it to stay right here in the United States to go into our 10% blend gasoline, because that gasoline demand is rising. 3 years ago, we were exporting about 10 or 12% of our production. Today, we're only exporting about 4% of our production. That's actually where the margin is made. That's the difference between making zero money and making about 60, 65 million a year, is the difference between here and here. We're actually consuming more ethanol in the United States at today's margin than we were 2 years ago. But the difference is we're not exporting about 600 or 700 million gallons a year that we were 2 years ago, and that difference in demand is extremely important to margin. So even though that margin chart looks negative, the ethanol industry, in fact, is sitting in a pretty decent spot. If we could get some world buyers to come in and buy something besides $27 crude oil and have them buy some ethanol, which is very hard to do. I mean, world buyers of ethanol buy it because it's an energy molecule. They're not going to go buy the cheapest energy molecule out there. Well, that's a crude oil molecule today. It's not an ethanol molecule. So we're going to struggle to get our exports up to a level they were a couple of years ago to bring the margin back into the ethanol business. But that doesn't mean we expect ethanol grind for corn to slow down. We really expect it to stay quite strong because we need most of it here. The funds, I think this is my last corn slide. The funds are what I'm going to talk about here. If we look at this particular chart, I know it might be easier to see the handout in front of you. If you look at the line here of the yellow bars, this goes back to 2006. This is roughly 10 years of data. This is weekly data. This line right here is the zero line. If you look at the funds position, when we look at the funds, we look at particularly managed money. Managed money is the group that goes long and short. They're the groups that's the group that throws around the most money every day. They're the ones that influence the price in a short-term basis, on a short-term basis, more than any other class. The only category of position holder with the CME that is larger than the managed money fund crowd is the commercials. URSA's a commercial, Ursa Farmers is a commercial. Ethanol plants are commercials. So exporters are commercials. ADM's a commercial. Cargill. So those guys hold the biggest position. The second largest position is managed money. These guys move around tens of thousands and thousands and thousands of contracts every single day. So we watch what they're doing. Prior to 2014, this managed money crowd was almost never short. They were always long. It's a matter of how long were they. Were they getting more long or less long? But they were always long. They were always invested in the commodity market. It's just to what degree. So prior to this, you see we're above the zero line here all the time with this yellow bar. The orange line is corn price. In 2013, they put on a record short position, and it ended in about December of 14. And at that time, they were short about 100 and call it 110,000 contracts. That's a little over 500 million bushels. And they covered that short position in a matter of about 3 months. And in that 3-month period of time, corn rallied $1.02. You look at the record short position of last summer. Many of you will remember last summer because it wasn't all that long ago. Did everybody sell enough corn in July of last year, this first or second week? It's one of them questions I don't get too many answers to either. I think